In today's video, I want to start with the very fundamentals behind investing, the building blocks, if you will, because in my opinion, you have to understand these concepts behind investing, but before you actually make any sort of actual investment. And so the first idea to understand is really what is the concept behind investing. And the major theory here is that you want to make your money work for you. And this is important because there are only so many hours in a day for one particular individual to earn income, right? We have lives to live, we've got families, we've got activities, we've got other priorities. But I think people often forget that your money is actually an extension of you and can work for you even when you're at a full-time job. And so the way to make your money work for you is through investment vehicles. And these vehicles are, you know, a vehicle is just a loose term used to describe anything that will generate a profit. And there are different types of vehicles: stocks, which are more of a high risk investment vehicle; bonds and cash equivalents, which are a low risk investment vehicle. And there are pros and cons to all of these: mutual funds, commodities, real estate. And all of these different vehicles, depending on a multitude of factors, have pluses and minuses to them. But the key here is that there isn't really one that is better than the other because it all has to do with your current financial situation and how you plan to use your money in the future. Ultimately, here, the end goal is to generate additional profit. You want to maximize your earnings potential. And what you do with that profit varies, but the goal for everyone is to generate some supplemental cash. So why do people invest? We understand the idea behind investing. What are some of the reasons why people decide to actually invest their money? The first one is to ensure financial stability. And again, this can be defined however you may want to define it, whether or not that's the ability to pay for college in the future, the ability to buy a car or house, the ability to support a family. These types of life necessities don't come cheap, and many people rely on their investments to support these financial goals. The second reason, decline of the pension. Gone are the days when corporate pensions guaranteed us income for life, mostly because many employers just don't offer pensions anymore. And so what this means is that the burden of maintaining your current lifestyle past our working years has shifted from that of the employer to that of the employee, which is you. And so to be able to support yourself in retirement, often the only way to do that is through long-term investing. So this kind of ties into our third bullet point. Our fourth bullet point, compound interest, which is simply the idea of generating earnings from previous earnings through reinvestment, right? So these reinvestments compound for you year after year, and your investments begin to grow and grow and grow exponentially. And finally, the last point, and there are many, but I think the last primary point is that doing nothing is losing. And this really points to the idea behind inflation, which erodes the value of your dollar. So if you think about it, over the course of many years, the purchasing power of your dollar buys a smaller and smaller percentage of goods and services, and that's really the idea behind inflation. I want to talk now about why investing may not actually be right for you at this particular stage in your life. And there are a couple of reasons. The first could be because you have too much credit card or loan debt. And it's probably important, actually, I would say it's critically important to pay off your principal amount as quickly as possible before your everything balloons instead of actually trying to make some sort of investment. Second, if you don't have an emergency fund, which is typically 3 to 6 months of living expenses stocked away for emergency purposes, this may be something that you want to consider first before investing. Third, if you need immediate cash to support a family, to buy food, to pay rent, these are absolute basics that must be prioritized over investments, in my opinion. And finally, a short investment time horizon. If you are close to retirement, if you plan on using your money within 1 to 3 years, then you're going to want to look closely at what type of investments you want to make or whether or not you want to be making any investments at this particular time. And I think that there's a key question to really ask yourself to help understand how you want to prioritize where you put your cash. And that is, if you won $5,000 today, what would you do with that money? And again, there's no right answer here, but answering the question will help you understand where you need to focus in this particular stage in your life. Now I want to talk about some different investment goals and why understanding your long-term goal is important to consider. So listed here are a variety of different goals, retirement, capital preservation, which is really the idea that you want to prevent sudden losses in your investment portfolio, college savings, buying a house or car, leaving a legacy, blowing millions at a bachelor party in Vegas during a night that you may or may not regret. Whatever your goal is, the point here is that all of these goals have different implications as to how you should invest, how long you'll need to invest, and also how much risk you might need to take. And so, no particular investment strategy is right, or no one particular investment strategy is right for all of these goals. They vary. And similarly, just like you have different goals, there are different investment vehicles that will align with your objectives that provide lower risk or higher risk depending on this ultimate goal. I want to move now from more of the theoretical ideas behind investing to some general questions that I think are important to ask yourself before investing. And the first one is to understand your risk tolerance and your personality. For example, do you like extreme sports and the thrill of roller coasters, or do you like calmness and stability and safety? And we asked this question, and actually, I'll step back. And Peter Lynch, who is a famous investor, says the key organ for investing is the stomach, not the brain. And I think what Peter Lynch is getting at is that if you are, you know, if you can't sleep at night because you're concerned about your investments, then you've probably taken on too much risk. So you have to understand how much you want to go through in terms of a roller coaster cycle, and letting your money sit through recessions, or whether or not you want to take that much risk, or whether or not you're more into not losing money. And that's going to have a significant impact on where you put your money. Secondly, how much time do you want to spend researching your investments? And finally, how much time do you have to let your portfolio sit and grow for you? And the reason why this question is important is because if you have more time, for example, maybe 5 to 10 years or longer, you might decide to take on more risk because you have more time to recoup potential losses from a market recession. Um, I want to end here with one resource that you can use to help determine your risk tolerance, and this is the Charles Schwab Investor Profile Questionnaire. And it's very straightforward, very simple. If you Google this, this questionnaire will help you walk through some of these questions and will better guide you to how you should prioritize your investment money. So, to end with some concluding thoughts, I would leave you with three key takeaways if you're looking to start investing. The first is that investing is about making your money work for you. Allow your money to maximize your earnings potential for you. Secondly, I would say that investing is different for each person based on numerous factors such as risk tolerance and time period and ultimate goals. And finally, I would say that reinvesting your earnings allows you to take advantage of compounding. So if you can, start early. Start early with investing. So hopefully this is helpful. And as always, feel free to reach out and we'll hope to see you next time. Thanks a lot.